Position traders basically buy an investment based on an idea, like a hypothesis that over the long term, their expectation is that the asset will appreciate in value. Now, this type of trader is going to be less concerned with the short-term price fluctuations or the market noise around the non-macro events. So there's going to be scheduled news, but a position trader is not really going to pay much attention to it unless it's, say, tier one. Position trader will mainly identify an asset or security that is set for a big macro move, where the chances of fundamentals changing within the short term are vastly reduced. Then when a trade has been identified, the idea is to get in at the early stages of the trend and wait for other traders to come in to the markets with the same conclusion as yourself. And then when they do that, it pushes your trade on and the asset price goes higher if you're long. A position trader is still speculating that the asset will appreciate or depreciate in value, but you're not going to have a vested interest in whether the outcome is bullish or bearish, as long as you're going to capitalize on the actual market move. The position trader doesn't worry about overnight risk events, but will keep an eye on, say, changes in monetary policy. If you're in the stock market, you'll be looking at corporate guidance. If you're in interest rates or foreign exchange, you're going to look to fiscal policy or maybe even regime changes. So that can affect the oil markets and all that type of stuff. There's a trader called George Soros. He was famous for taking a position in the British pound. After he'd done his fundamental analysis, that brought him to the conclusion that the pound would devalue after a macroeconomic event. And Soros was able to pocket $1 billion on his trade and became infamous for being the currency speculator who broke the Bank of England. That's the kind of thing you can do when you're a position trader.